Welcome, everyone. Thank you so much for joining us for today's Appraisal Buzzcast. We've got a great episode with you. I'm Jim Morrison, and with me is our host, Hal Humphrey. Hal, how are you doing?
Jim, I am hot today, but fantastic. It's a beautiful day. Happy to be here. Looking forward to this interview.
Hot here, but it's going to be hotter when we're in Vegas coming up, so we're just getting used to it. Well, somebody will be joining us in Vegas is Lyle Radke, who's the Senior Director of Collateral and Policy at Fannie Mae. Let me bring him in. Hey, Lyle.
Hi, Jim. Hi, Hal. Thanks for having me.
Lyle, thank you so much for joining us today. I'm always happy to have you back on the podcast. For some of our newer listeners who haven't gotten to hear from you before, your history in the industry is kind of well known, but give us a really brief, how long you've been doing this and what is your current role at Fannie Mae?
Yeah, some people would say I could never give you a really brief answer, but I'll try. I've been in real estate now for about 30 years. I started as a framer for a construction company. I worked for them for a short amount of time, and then I became a real estate appraiser. And I appraised for about 9 years in the Albuquerque, New Mexico area. I should say before becoming a real estate appraiser, I went to college. I have a master's degree in geology, so I'm a science nerd. I love science. I love data. And I think that scientific background and approach is something that really has influenced my whole career and how I approach the valuation problem. So then after, I'd say about 8 or 9 years appraising in Albuquerque, felt like I wanted to do something a little different. And I found a job with a bank in their servicing department, reviewing appraisals and BPOs and other valuation products, AVMs, for servicing purposes. And one of the fun things about servicing is it's tragic, but it's also, from an intellectual perspective, very interesting. You see all the weird stuff. And I learned more in a year there than I had learned in 9 years in the field. You see a lot of properties. You can see there were certain products where I might look at 50 products in a day. So I'm seeing a lot of different properties, and I'm seeing weird stuff and junk stuff. And I'm seeing what happens to that loan after it's originated. Very educational. One of the things that we did there is we worked with paper. So we would get our product, our appraisal, what have you, and we would print it out and we'd put it in a stack. And then the secretary would put a sticky on top of that stack, like July 17th. This is the stack of stuff she printed today. And then tomorrow there would be a new stack for July 18th. And you were expected to go and take stuff off the oldest stack and work on it, right? And every now and then stuff would get lost and people would be like, I printed that on the 12th. Where is it? And everybody's like, I don't know. And it's always like the super hard ones that were getting lost, right? So we needed a control environment, and we decided to build an electronic platform for managing our workflow. And that got us into the concept of building an XML-based appraisal flow, right? So just the software companies were beginning to be able to generate an XML version of an appraisal report. And so we took advantage of that. We built our platform to consume that. Well, fast forward a few more years, and Fannie Mae wanted to build an XML-based appraisal platform, which they did, which you today know as UCDP. And they came and talked to us about our experience with our platform. And that's sort of how I got connected with Fannie Mae. And then, a couple of years later, I made the leap over here to Fannie Mae to work on their collateral control, appraisal control structure. Been here ever since. Love it. Great place to work.
It's shocking to me how much I learn every time I talk to a guest on the show, and we've been on together a couple of times. I just learned some things that I did not know about you, Lyle. So you're telling me that you went from a 22-ounce East Wing framing hammer to a rock hammer to a tape measure to a tree-killing appraisal reviewer.
I did the rock hammer before the framing hammer, actually.
Okay. I love it. Well, let's do this. Let's take a quick break and hear from one of our sponsors, and we'll be right back.
LIA Administrators and Insurance Services, serving valuation professionals since 1978. We provide E&O insurance with a commitment to superior customer service, outstanding liability education, and unmatched claim defense, benefiting over 10,000 real estate professionals nationwide. Explore our exclusive appraiser liability education by Peter Christensen and cost-effective seminars designed to foster your growth. Our underwriters, with an average of 26 years of experience each, are dedicated to supporting appraisers. Visit liability.com to discover how LIA can safeguard your business.
Welcome back, everybody. You're listening to the Appraisal Buzz. I'm Hal Humphreys, your host. I'm joined today by Lyle Radke from Fannie Mae. Lyle, Fannie Mae just released an appraiser update that had some fairly significant policy news in it. We'll share a link in the description of the podcast for anyone who wants to hit pause to go read it first. For those of you driving and can't stop to read it, or those just don't want to read in general, can you tell us some of the biggest information included in that update?
Sure. It covered 3 topics. And let me start by saying the appraiser update, our quarterly update, it's not actually establishing new policy. The policy instrument for Fannie Mae is the selling guide. And so if you want to know the policy, you have to look to the selling guide. But what we try to do with the newsletter is share some insights into how to appropriately implement that policy, right? So in this edition, we have 3 topics. One is about the new reconsideration of value policy that Fannie, Freddie, and HUD all published in May. We have an aligned policy across those 3 organizations, and of course that covers the vast majority of loans in the primary mortgage market. Mm-hmm. Then a second article was about appraisal defects, problems we see when we review appraisals, the kinds of things that could end up being a repurchase for a lender, the kinds of things that could end up being a referral to a state regulatory agency for an appraiser. So just some suggestions, just a real quick hit on here's 4 or 5 common problems we see, and here's a suggestion on how to avoid this problem for each one, right? So I think that's a real practical article for you. And then the third article is about the 1007 rent schedule form and how to apply that in a short-term rental context.
So let's do this. Let's get into the ROV parts of this first. Will these changes lead to more reconsideration of values for appraisers, or will it streamline the process because there'll be a standardized way to deal with it?
It's a great question. So I don't know the answer to that. I can't really make a projection. But what I can say is that all lenders already have and have had reconsideration of value processes. This is not a new idea. Clear back when I was appraising, I received reconsideration of value requests from lenders. So we've all received them. It's something that's been around for as long as there have been lenders and appraisers, right?
Right.
What we've tried to do is create some sense of responsibilities and rights and responsibilities for both the borrower and for the appraiser. So creating some certainty around what the expectations are. And I think by creating expectations for the borrower, it's possible that you might see more because they are being informed that they have a right, but you might see fewer, or you might see better because they're being told they have a responsibility. There's obligations for the content that is appropriate for a reconsideration of value. For example, they can't just say, "Hey, I hate this value. It's not what I expected," right? The policy requires them to provide evidence and then to talk about how that evidence impacts the results. And so it's really intended to be an evidentiary argument that the borrower is going to put forward. That's a high bar for your typical borrower. They're not necessarily well equipped to do that. So it's going to be interesting to see how that plays out.
Yeah, and never mind the fact that at loan closing and at loan origination, both there are countless disclosures that buyers acknowledge. I personally think that, the disclosure of the ROV process is going to be one of all those many that the borrower sign. Some of them may pick up on it, some of them may not. But the requirement to have the borrower provide specific information, I think, is a really good thing for appraisers, because that will, in fact, in my opinion, cut down on the frivolous, hey, I just don't like this number requests. Let me ask you this. What kind of documentation or justification can appraisers expect to receive, and what are they going to have to provide when responding to an ROV under the new policy?
Well, what our policy calls for is the borrower should provide supporting information that identifies and describes what they consider to be unsupported, inaccurate, or deficient items, meaning in the appraisal, along with additional data, information, and up to 5 comparable sales, with an explanation of how the new data supports the reconsideration of value. So it's pretty wide open. Like, it could be data, it could be information, it could be comparable sales. They might say, hey, you mismeasured the back of my house, so I took my own tape measure back out there, and here's the correct dimension, right? They might say you missed the bathroom. They might say you got the description of the house right, but what you don't understand is that everybody loves our view, and here's a couple comps that have that view that show this, right? So it's intended to be an argument that would reach into the way appraisers think about the problem, and really speak to appraisers directly about the way that we think about the valuation problem. I expect that the borrower is probably going to have to get some coaching, right? Some borrowers might be savvy enough to do this, but they're if it's a purchase transaction, they're working with a real estate agent. That real estate agent may be helping them to figure this out. The lender is going to have an important role in this. The lender is going to have to take whatever the borrower sends and ask themselves, does this meet the expectation? Is this sufficient justification that it might persuade an appraiser, or that it might be relevant to an appraisal? And if not, the lender might push back on that borrower and say, you have to do a little more. So it remains to be seen. But the idea here is that borrower is going to have to provide factual information to support their complaint. It can't just be an emotional appeal.
Nice. And I think, realistically, there may be a business model in here for some appraisers to provide that coaching, to borrowers if they would like to step out into that world. Let's do this. Let's take another quick break and hear from one of our sponsors, and we'll be right back.
The Dictionary of Real Estate Appraisal, 7th edition, is a landmark text that reflects the depth and breadth of appraisal knowledge. Each entry, definition, and reference has been painstakingly researched and designed to reflect an expert understanding of issues that currently impact the profession. The new dictionary is an essential authoritative resource for all appraisers. The dictionary is divided into 2 sections, an alphabetical listing of terms directly related to real estate appraisal, and an addendum with topical glossaries and compilations of terms used by related real estate professionals. Find it at appraisalinstitute.org/dictionary7.
Welcome back, everybody. You're listening to the Appraisal Buzz. I'm Hal Humphreys, your host, and I've got Lyle Radke on the line with me today from Fannie Mae. We've been talking about the most recent update from Fannie Mae. Another topic in this update, Lyle, is guidance on short-term rentals. There's been a lot of misinformation out there in the industry on this topic, and we're really kind of thrilled to see some official policy around it. What are the key considerations for appraisers when dealing with short-term rentals, and how does categorizing short-term rental income as rental income versus business income impact the appraisal process?
Yes, thank you. So that's the heart of the matter, right? There's 2 key considerations. The first is the appraisal itself, the valuation, and that must only include the real property. So this is a good thought experiment for appraisers, right? Any personal property, such as furnishings, have to be excluded from the value. Similarly, the appraiser cannot attribute value to the business or the going concern. That's not real property, right? That's kind of an intellectual property. So practically speaking, what this means is that the value of a property being used as a short-term rental is the same as it would be if the same property or a very similar property were not being used as short-term rental. In this case, the usage does not change the value, right? Now, as an aside, there may be other highest and best use considerations, such as zoning, but you already know how to deal with those, right? That's a more fundamental question about what is the legal bundle of rights. Appraisers are already equipped to solve that, and you would treat that just like any other appraisal assignment. So it's not. I wouldn't consider that to be unique to short-term rentals. But in terms of short-term rentals, I think the key here, the first key is you're appraising the real property. You're not appraising the personal property. You're not appraising the business, at least not if you're doing a GSE or Fannie Mae loan.
Okay.
Okay, the second thing then is the income. Now, the question of income is, first of all, a scope of work problem with your client. Your client may not ask you to do anything on the income side, because underwriting income is not an appraisal problem. That is a lender problem, right? And the lender has instructions in our selling guide on how to document income. And the 1007, the rent schedule form, is one of the options for documenting rental income for the subject property, but it's not the only document, right? This is going to be usually obtained in context of lease agreements. And if you think about a short-term rental, you may not have lease agreements, right?
Right.
Or in terms of income tax returns. So they're going to look at potentially the business income and how much income was generated last year on this short-term rental. So the 1007 isn't a standalone. It is in context of other income underwriting documentation that the lender is responsible for. So the way for the appraiser to think about it is very narrowly. You, the appraiser, only need to comply with the definitions and instructions on that form if asked to do so. And the form itself is pretty restrictive about what it calls for, right? The form requires the appraiser to conclude to an indicated monthly market rent. Monthly, right? Monthly rent. And the form is set up like a grid, just like the sales comparison approach. So you're going to provide 3 rental comparables that are rented on a monthly basis. Now, that's not a nightly fee, right? That's not what the form calls for. So it's not appropriate to use other kinds of data or other kinds of analysis to complete the 1007. It needs to be done exactly the way it's prescribed. You're going to, again, provide 3 rental comparables. They're rented on a monthly basis, and you're going to use that to derive a monthly market rent. That's what you're going to deliver. So I think there's some implications for that, which let me pause, Hal, and get a reaction from you before we dive into the implications. But that's the task for the appraiser. Appraise the real property, provide the monthly rent. Don't worry about the rest of it.
Yeah, and a couple of points I want to bring out in that. So when you say the form, the 1007, is designed to get monthly rent, that is not necessarily the same as monthly income, which was what you'd be looking at for short-term rental. And income would include real estate, furniture, fixtures, equipment, and goodwill, and all of those things, whereas a monthly rental rate is what the form is asking for. And you know, Lyle, from my perspective, I've always had the feeling that when some lenders have requested that appraisers put short-term rental information on that form, it seems almost kind of de facto misleading, and no amount of additional information at the back of that form gets away from the fact that the form is designed for monthly rental situations. And if somebody presents that on down the line in the loan process, somebody might take that and say, oh, this is monthly rental, and not really dig into, oh, wait a minute, this is short-term rental. And there are ways for lenders to consider short-term rental income as it could a bunch of other different types of income, but that's not the same as a monthly rental for a piece of real estate.
Exactly right. Exactly right. So the again, using the 1007, this is not a nightly fee that you're representing, and it would not be appropriate to use a creative method like taking a nightly fee times 30 or taking a nightly fee times 30 minus business expenses to try and get to a monthly amount. That's not what the form calls for. That would be misleading if you did that.
Okay. Well, I think you just answered the very last question we had, which was 1007s. Can you give us a definitive answer? I think you just did. Short-term rentals, the lenders are allowed to consider that income, but it's not an appraisal function. Appraisers, we are looking at real property. That's kind of our wheelhouse. I know some appraisers deal with business value in other areas of their work, but that's not what we're talking about here. So, Lyle, I really appreciate you taking the time to kind of clear those things up. It's nice to have some direction.
That said, I think I should hedge a little. So, a couple things to keep in mind. There are many mortgage investors with different requirements. So not all loans go to Fannie Mae.
Right.
And while Fannie Mae allows the 1007 under certain circumstances, even for short-term rentals, the appraiser may not know the lending circumstances. So if you think about this from a business perspective, if the lender wants a 1007, well, sure, why not? Take the money, right? However, if they ask you to corrupt that 1007 or contort it to try and do something other than what it's designed to do, then you need to talk to them about that's not what you're going to do, right? If you're going to give them the 1007, you're going to do it the way it's prescribed. If they want you to derive a nightly fee or do some sort of an income assessment, maybe you can do that, but you would just put it on a different report. You wouldn't put it in a 1007, right? And you just want to be transparent with your customer about what you're going to do and how you're going to do it and how you're going to report it.
Absolutely. And at the end of the day, I mean, we tell appraisers all the time, say what you did, tell us why you did it, explain your rationale. That is what we're doing. And part of the scope of work issue that you're talking about is you've got to talk to your clients and define what the scope of work is. And it may be okay to analyze short-term rental, even as an appraiser, just not using this form. Look, again, I think it's really nice to have the clarity on those issues. I'm curious to see the reaction from the appraiser world and the lender world to the new ROV policy and what that ends up looking like. Policy goes into effect August 29th, is that right?
Yes, August 29th for the reconsideration of value, yes.
Okay. So it'll be interesting to see how that all shakes out. And look, you've said a couple of times through this podcast, and I want to reiterate this for our listeners. Whenever you have questions or concerns about what is appropriate for something that's going to go to Fannie Mae, there is one really good resource out there that we have as appraisers, and that's the Fannie Mae Selling Guide. If you have concerns, I beg you, don't reach out to Facebook for the answers. Go to the Selling Guide. Is that fair advice, Lyle?
Yes, and we've tried to make the Selling Guide more accessible through the internet. So you can Google a specific topic and it will bring you back the actual place in the Selling Guide where that topic is addressed. So you don't have to read the entire 1,300 page Selling Guide in order to hunt and peck for what you want, right?
And so much of the 1,300 pages doesn't apply to us appraisers. There's a specific section of the 1,300 pages that applies to us as appraisers. So yes.
And that's a lot shorter. But I will also say this. When you get into the Selling Guide, keep in mind it's written for a lender. So it's a little bit like Jeopardy. You know how in Jeopardy you have to phrase the answer as a question? When you read the Selling Guide, you have to sort of translate it. We're telling lenders who are our contractual partner how to originate loans for us. And part of that is telling them how to instruct and work with appraisers. So it won't say appraisers do this. It'll say lenders cause your appraiser to do this or something like that, right? So the language is a little contorted in that way because of the audience. And just keep that in mind as you're reading it.
Yeah, great advice. Lyle, again, thank you for being here. I really appreciate your time. I know you're crazy busy. Jim Morrison, are you still with us by chance?
Yes, absolutely. I was going to say, Lyle, before we let you go off the hook, we do have an anonymous appraiser question for you this week. So this one was posted recently in the Aloft appraiser community group. Heather Sullivan and her team do a great job. They're going to be at Valuation Expo as well if you want to meet them there. But this one says, I'm applying to an appraisal company. One of the requirements is to give the company access to your signature. And then they put in quotes, I guess what it says. I hereby authorize my supervisory appraiser to affix my signature to completed appraisal reports on my behalf. Is this allowed through USPAP, Fannie, etc.? My research online yields conflicting info.
I'm going to take a stab at that first from a USPAP perspective, and then I'll let Lyle chime in on Fannie Mae's perspective. If you go to Uniform Standards of Professional Appraisal Practice, under the ethics rule, the last section there is called management. The very last, second to last paragraph, last sentence says, an appraiser may authorize the use of his or her signature only on an assignment by assignment basis. So I'm going to say there's not really any conflicting information there at all. It's pretty clear. You can allow someone else to use your signature on an assignment by assignment basis, but I don't think USPAP envisions it being okay for you to just sign over the rights for anyone to sign your report going forward. Lyle, what does Fannie Mae have to say about it?
Yeah, so we're definitely not the source of truth for interpreting USPAP, and so I'll defer to you on that, or the appraiser might want to talk with the Appraisal Foundation or with their state board. But that said, it is common business practice to delegate clerical functions such as report preparation, so that's not really a problem. And part of that delegation might be to instruct somebody to fix your signature. The thing is, the signature, the purpose of the signature is to enable the appraiser to control or monitor the report content. The appraiser is ultimately responsible for the report. So when you delegate your signature to somebody else, you cut off your ability to or bypass that control over the report content. So that's a risky situation. And the only thing I would say is, in terms of advice, is if you want to have a really high degree of confidence and trust before you allow someone else access to your signature, because you're bypassing that control, right? So if you're entering into a new relationship, I'll be very cautious about that level of delegation until you've established that trust.
Yeah, no doubt. And look, go to USPAP, read it for yourself. Again, when you're dealing with Fannie Mae, go to the selling guide, find the answer. If you're asking a USPAP question, go to the document. We've all got a copy of it, right? Look it up. It's fairly easy to find. It took me less than a minute to get to that one sentence. Call the Appraisal Foundation. They are there to answer our questions as appraisers. If we have a concern about something involving USPAP, the Appraisal Foundation produces a book. They will answer your questions. Reach out to them. They actually are very helpful. So again, Lyle, thank you for taking the time to be here. It's always good to see you. Morrison, do we have anything else we need to cover today?
No, I think we covered all. Lyle, thank you so much for joining us today. We're looking forward to see you and Fannie Mae at Valuation Expo. We appreciate you partnering with us on that and being a sponsor of Valuation Expo. It means so much to us.
Well, thank you, Jim. Thank you, Hal. We appreciate the partnership.
Cheers. Thank you. So if we have nothing else, for Jim Morrison and Lyle Radke, I'm Hal Humphreys, and that is your Appraisal Buzzcast for this week.